Now we continue with our chapter 1. We are concluding chapter 1. I think we have two more subtopics remaining. And you can see from that other side, we are discussing about share-based payment, and that is IFRS 2. I think you can see that one very clearly from that side. So we discuss that particular topic. Is we do some examples. So you can see from this side, we are taking share-based payments, that is IFRS 2, that is International Financial Reporting Standard number 2. After we discuss what IFRS 2 is all about, the next thing we will take a question with a solution, and that is Advanced Financial Reporting, September 2021, question 3B. I advise that you have that paper with you so that you can move faster. And then after that, I will also take December 2017, question 2B, Advanced Financial Reporting, Kasneb. So try to see what I've tried to do here, because as I told you, chapter 1 is not a complicated area. The areas which are a little bit complicated, which requires you to spend much time, is chapter 2, which has to do with group accounts, including group cash flow statements. For chapter 1, these are very simple things, and we agreed that we complete chapter 1 this week. So 2 more lessons, that is before Friday, or over the weekend, we should have completed chapter 1. So next week, we will be dealing with chapter 2, which is to do with group accounts. Now, basically, what we mean by share-based payments, or IFRS 2, there are those situations where you can supply goods or services to an entity, and then that particular entity can pay you in terms of shares, or that now these shares, let me call them equity. They can pay you in terms of equity or otherwise. So in this case, you are not receiving cash as your payment. Even in those situations where you are receiving cash, this cash is based on the value of equity for that particular entity which was to pay you. So that is it. That's what we will be interested in here. Situations whereby you have either supplied goods or services to an entity, and that entity may pay you in terms of equity or cash, which is determined based on the value of equity of that particular entity. That's IFRS 2, share-based payments. And we have 3 types of share-based payments. And one, as I've told you, is equity settled share-based. Equity settled share-based. So what it means by equity settled share-based is that you supply either goods or services to a business entity, and then you agree that you will be paid. The consideration here that you will receive will be based or will be in terms of equity or shares in that case. That is equity settled share based, and the other one is known as cash settled share based. Cash settled share based. What it means is that you will receive cash, correct, for the supply of goods and services to the entity, but this cash that you are receiving, that is your consideration, is based on the value of the shares or the equity of that particular entity. And then the number 3, the other type of share-based payment is known as equity settled or cash settled. So it can either be the two of them, the first two. You see, the first one is known as equity settled share-based. Number two is cash settled share-based. And number three is equity settled or cash settled. So I think that is as simple as that. The types of share-based payment, they are those three. Now I want us to take an example here, but before I take that particular example, we are going to take it together. Allow me to remind you what was in chapter 1, because we are winding up chapter 1, what we have covered in chapter 1 so far. And if you are just joining us, make sure you subscribe to our YouTube, Fatima Institute, so that we may move together. We are winding up chapter 1. Now, chapter 1 is about accounting for assets and liabilities, whereby we are supposed to know leases. Leases, we did leases, that is operating lease as well as finance lease. We covered that. You can find those classes in our YouTube, comprehensively covered, well explained. Then deferred tax, we have done deferred tax, we have completed that. If you did not attend the class, then you can follow us up in our YouTube. Then employee benefits, we have also covered that. That is IAS 19. If you have missed our classes, just go to the YouTube. You follow us from there. Our numbers are there. Our contacts are there. In case you need any help, just call us. We will assist you as much as we can. So share-based payment, employee benefits, we have covered that. Now today, we are doing share-based payments, which is very simple, and that is IFRS 2. After you've done share-based payments, we have two more things to do. That is financial assets and financial liabilities, as well as impairment of assets. So two more lessons, or three, we will have covered the chapter 1 and we move to chapter 2. Now let's take up an example as you see it here. Now something that I want to remind you is that because again share-based payment is not a difficult area. Now realize this, you will be having a column for the number of years, another column for your workings, another column for accrued expense, and the last column for expense for the year. A major difference will arise in those situations where equity settled shares, where you are settling these payments through equity, and the other situation where you are making the settlement by cash. Well, the major difference is that you can see here what we are saying. We are trying to multiply by a certain number here. We discuss this question. Now this is the as you can see this point here, the note. For equity settled shares, use fair value of shares at the grant date. The grant date. So if you are told that we have a share-based payment arrangement and the method that we are using is equity settled, then throughout you'll be using the price which was prevailing as at the grant date. Therefore, that price will be constant throughout. That's very important point. The other situation is where the settlements are being done through cash or cash settled shares. Remember, we have said there are three types of share-based payments, either through equity or shares, that's cash, equity or cash, or equity and cash. So the two differences you will see as we attempt this question here. What is the major difference? The major difference arises in terms of this number you are trying to multiply here. Now, if you are using cash based payment, then you will use fair value of shares each year. So these figures will be changing. The number you're multiplying by will be changing based on the fair value of shares each year. Okay, straight away, uh, let's take that particular question. That is September 2021, question 3b. September 2021, question 3b, advanced financial reporting. So just open that particular question. I told you have the papers with you so that we can move faster. I'll project that paper in front of your camera. I don't know whether it is in front or it is at the back, but let me read that question. That is September 2021, question 3b. Peponi Limited decided to grant its 500 employees 200 share options, each from 1st July 2021, on condition that the employees still be in employment as at 30th June 2025. The company has provided the following details regarding the share option scheme. Now we have the years 2022 up to 2025. Then you are given number of employees expected to leave, then fair value of each option. Then the fair value of the option was shillings 40 as at 1st July 2021. The exercise price of the option was shillings 15, and the par value of the company's share was shillings 10. The average market price of the share over the 4-year period is expected to be shillings 50. Required extracts from the financial statements of Peponi Limited for each of the years entered 30th June 2022, 2023, 2024, and 2025 to reflect the above transactions. Now, allow me to project that one to you in case you do not have that paper, but it is always advisable to have those papers with you. Now, if you can just see it there, how it looks like. Now it is there. It is just there. That question there. What I told you can see Peponi Limited decided to grant its 500 employees 200 share options, each from 1st July 2021, on condition that the employees still be in employment as at 30th June 2015. The company has provided the following details regarding the share option scheme. You can see the first column, the year entered 30th June 2022 all the way to 2025. The second column you are given, number of employees expected to leave employment, 40, 30, 25, 25. Those are the employees leaving or expected to leave. Then fair value of each option. Now, the fair value of the option was shillings 40 as at 1st July 2021. The exercise price of the option was shillings 15, and the par value of the company's share was shillings 10. The average market price of the share over the 4-year period is expected to be shillings 50. Required extracts from the financial statements of Peponi Limited for each of the years entered 30th June 2022, 2023, 2024, and 2025 to reflect the above transactions. Now, before I explain to you the solution as it appears on the board, look at those columns, especially the second column, and the third column. Now, the third column will be irrelevant because this is equity settled shares. The third column is irrelevant because we have said the difference between equity settled and cash settled is that if you are using equity settled, we use the prevailing price as at the grant date. As at the grant date. This four you can see here throughout. Now, maybe you pause your video where we were showing this. Now, let me show you again so that you may pause your video and maybe you record it somewhere. Okay, just let me show you again so that when I go to the other side, I just show you the solution. See how that, especially the table, how it looks like. We are able to check that to be very good for us, especially check the second column. The number of employees expected to leave employment. Now, that is it. But again, I believe you have those past papers. I believe you have those past papers. So note that this is an equity. This is an equity settled shares. Note this point here, very important. For equity settled shares, use fair value of shares as at the grant date. For cash settled shares, use fair value of shares each year. Now, let's show you the solution. Let me show you the solution. Quite simple. So what you do is that you have a column for year one, the number of years as per the question. So this is from year 2022 up to 2025. Now, the grant date is 1st July 2021. We are told the Pony Limited decided to grant its 500 employees 200 share options, each from 1st July 2021, on condition that the employees will still be in employment as at 30th June 2025. So your number of years will go up to 2025. The company has provided the following details regarding the share options. The fair value of the option was shillings 40 as at 1st July 2021. So 1st July 2021 was the grant date. So you ask yourself, what was the price of these shares as at the grant date? So that is 40. We have said that where we are using equity-based, then you use that prevailing price as at the grant date. So throughout, you'll be using 40 throughout. But if it was cash-based, then we could be using the price for those shares in each particular year. That's what we mean. So let's come back here. So you understand what you have done here. The years are given there. We know those years. Now here, I just show you the workings. What we are doing is that, remember, we have 500 employees. So the first year here, we have 500 employees. But if you look at the second column, you are told 40 employees are expected to leave employment. If you look at the second column, 40 will leave. So if 40 will leave, we started the year with 500 employees. If 40 leaves, you minus the 40, you are left with 460. So here, 500, you started that particular year with 500, 40 left. We multiply by the number of options. There are 200 options. We are told the Pony Limited decided to grant its 500 employees 200 share options. So multiply by 200, then times the price as at the grant date. Remember, this is an equity settled shares method. So we multiply by 40, that was the price as at the grant date, which is given them after the table. You are told the fair value of the option was shillings 40 as at 1st July 2021. That was what was the price as at the grant date. Right, 40 times, these are 4 years. So you multiply by 1 over 1 over 4. So for the first year, you multiply by 1 over 4. The answer which you get here is the accumulated expense for that particular year. Accumulated expense for that particular year. It will be the same for the expense for that particular year. So for the first year, the accumulated expense will equal to the expense for that particular year. That's for the first year, 2022. When we go to 2023, the number of employees that you expect to have, because you have 500 employees, 40 are expected to leave. So you'll be left with 460. By the start of the second year, you are left with 460. That was 500 minus 40, you get 460. Then the second year, 30 of them are expected to leave. If you look at the second table, that's the second column there, second year, 30 are expected to leave. So 460, remember this is the balance which remained after the first year, after the 40 left, you are left with 460. And in this, the same year, 30 are expected to leave. So 460 minus 30 times 200, the number of options, times 40. Now 40 is the price is at the grant date. You have said where you are using equity-based share payment, then you use the price as at the grant date throughout. That does not change. So multiply by 40. So 460 minus 30 times 200 times 40 times 2 over 4. 2 over 4, because we are in the second year and there are 4 years. So 2 over 4, you get 1,720,000. Then, so this is the accrued expense. How will I get the expense for the second year? Because this figure comprises of year 2 and year 1, you just take 1,720,000 minus 920,000. You get 800,000. That is the expense for year 2. Then we go to 2024. 2024, the second year here, that is 2023, we had 4 system, 30 employees left, so we were left with 460 minus 30, 430, minus 25 employees are expected to leave. So 430 minus 25 multiplied by 200, the number of options, times 40. We say 40 is a price as at the grant date, because this is equity settled share. 40 times 3 over 4. We are in the third year, so times 3 over 4. If you multiply this, you get 2,430,000. And then this is an accrued expense for the year 2024, or the third year. What is the expense for the third year? That is 2,430,000 minus 1,720,000. You get 710,000. That is the expense for that particular year. Then you go to the last year, 2025. In this particular year, 2024, we had 430 employees minus 25, the employees who left. So when 25 employees left, we were left in the year 2025, there were 405 employees. The same year 2025, 25 were leaving, were expected to leave. So multiply by the number of options, which is 200, does not change, times 40. Now 40 is the price is at the grant date, multiplied by 4 over 4, because we are in the 4th year. or just times 1, because 4, right, 4 over 4 is 1. So multiply by that, we get that 3,040,000. What's the expense for the year? 3,040,000 minus 2,430,000, you get 610,000. So 610,000 is the expense for 2025. So this point again is very important for the purpose of the exam, because it is the one that may make you to get a 0 in a question which is testing share-based payment if you don't understand how to go about it. I repeat that for equity settled share, like what we have done here, use fair value of shares as at the grant date. Now, what is grant date? That date when we agreed, when the entity and the other party agreed on the share-based payment. When did we agree on this payment, on this share-based payment? Which date did we agree on that? So that particular date, when we agreed, you ask yourself, what was the price of this particular financial instrument? So that particular price will be constant throughout. That is why we are multiplied by 40 throughout. So that is it. But if it is cash settled, then you'll be looking at the price for each particular year. You'll be given prices for year 1, year 2, year 3. So you'll be multiplying by those prices. Now the other part is quite simple. Income statement extract. Now income statement, realize that you just take these figures here. These are the figures that will appear in the income statement. Year 1, 720,000. No, not 7, 920,000. Year 2, 800,000. Year 3, 710,000. Year 4, 610,000. So income statement extract, the figures that would appear there are these figures as you see them there. And I've shown you how to arrive at them. Then if you are to prepare statement of financial position extract, then these are the figures to appear there. Year 1, 920,000. Year 2, 1,720,000. Year 4, 2,430,000. And year 4, 3,040,000. So these are the figures which will appear in the statement of financial position, and these are the figures which will appear in the income statement extract. End of that question. End of September 2021, question 3B. So the major thing that you have learned there that I want you to understand as of now is how to account for these options or these particular instruments where we are using equity settled shares and where we are using cash settled shares. So the first question, I've done that illustration to show you the difference between the two. Purposely, you can see this question I have used a situation where we are using equity settled shares method. Now I want us to look at December 2017, question 2B, whereby we are using cash settled shares. So note the difference now. Cash settled shares. The previous example we have done there is equity settled. What you have done there is equity settled. You can see how we have used this 40 here. The 40 is the price of, or the price prevailing as at the grant date. Now, see what will happen here. Let's move to December 2017. December 2017. Question 2B. Question 2B. It should be there. I read it for you. On 1st January 2014, R Limited promised to pay its 200 employees a bonus in cash. So a bonus in cash. It's not equity. They are not being granted. They are not being paid in terms of equity. they are being paid a bonus in cash. So that is a cash settled share based. You've seen there are three methods: equity settled share based, cash settled share based, and equity settled or cash settled. Eh? You remember that? That is what we are saying. Now here we are saying on 1st January 2014, R Limited promised to pay its 200 employees a bonus in cash that would be based on how the company's share performed on the securities exchange. The bonus was to be paid on 31st December 2016 as long as the market price of the company's share was shillings 55 and above, and the employee was still working for the company. As at 1st January 2014, the market price of the share was shillings 50, and the par value of one share was shillings 10. The bonus was to be the equivalent of 100 shares. The following information in relation to the 3 years was availed. I just present that to you how it looks like. I'll show you how it looks like. That information. I believe you have the paper. I believe you have the paper with you. You should be having that paper. Alongside what I have read for you, you can see there the following information in relation to the 3 years was availed. Year entered that 1st December 2014, that 1st December 2015, that 1st December 2016. You are given number of employees leaving 10, 15, 15. Market price of shares 55, 58, 60. And then you are told all the employees who are in employment as at that 1st December 2016 were paid the bonus. The term required to show how the bonus would be accounted for and reported over the 3-year period entered that 1st December 2016. Are you able to see that question? On 1st January is question 2b. On 1st January 2014, R Limited promised to pay its 200 employees a bonus in cash that will be based on how the company shares performed on the securities exchange. The bonus was to be paid on that 1st December 2016 as long as the market price of the company share was shillings 55 and above, and the employee was still working for the company. As at 1st January 2014, the market price of the share was shillings 50, and the par value of one share was shillings 10. The bonus was to be the equivalent of 100 shares. The following information in relation to the 3 years was availed. So you can see that. Required, show how the bonus would be accounted for and reported over the 3-year period ended that 1st December 2016, 6 months. Now let me show you how to go about it. The solution appears on this side, on my board. Look at the solution. Eh? Look at my solution. Note what we have said. That if we are using cash settled share based method, then we use the prices prevailing in each particular year. So what does it mean? You can see that we are multiplying here by 55, 58, and 60. You know where those numbers are coming from? Now that's important. So I think it is important that I show you that. You can see market price. If you look at the last column, market price of a share, you have shillings 55, 58, and 60. Now, because you are using uh, cash settled shares, we are using cash settled share based method. We have said you multiply by the prices prevailing in each particular year. You can see after the first one we have done, we are multiplying our number of options by 40. And 40 is the price for that particular financial instrument is at the grant date. That's the major difference there. You can see. So you go to here, so we have the same format here. You have 2014, 2015, and 2016. So how many employees were there? We are told on 1st January 2014, R Limited promised to pay its 200 employees. So there are 200 employees. In that particular year, 10 of them are expected to leave. If you look at the second column, number of employees leaving. So we have 10. So first year, 10 will leave. There are 100 options. That is stated, the last line there, you're told the bonus was to be the equivalent of 100 shares. The bonus was to be the equivalent of 100 shares. So you multiply by 100, then multiply by 55, because 55 is the market price of a share in each particular year. You have said that's the major difference between this question and the other. The first one we are using equity settled shares. The second one we are using cash settled shares. For cash settled, you multiply by the price prevailing in each particular year. So you multiply by 55 and then you multiply by 1 over 3. 1 over 3. There are 3 years, first year. So accrued expense will be 348,303. That is the accrued expense. It is the same as the expense for that particular year. When we go to the year 2015, the first year, 10 of them, 10 employees left. So we were left with 200 minus 10. You are left with 90. 90 we are told, the year 2015, 15 employees are expected to leave. So it started with 190. Remember the first year, we started with 200, 10 left. So 200 minus 10 is 190. The year 2015, 15 left. So obviously we are left with 175. But finish up 2015, 190 minus 15 times 100. 100 we have said is what? You are told the bonus was to be the equivalent of 100 shares times 100 times 58. So this the second year it has to change because you are looking at the price in the second year, 2015, times 2 over 3. We are in the second year and there are 3 years. So 2 over 3. We get 676,667. Then we want to see what is the expense for the year. The expense for the second year. You take 667 minus 348,303. So you minus that, you get 328,304. You go to 2016, how many employees do we have? The second year, there were 190, 15 left, you are left with 175. 175 employees, you minus 15. 15 were leaving. If you look at that column, it is showing the number of employees expected to leave. 15 left. Multiplied by 100, the same. The same remains. As you can see, even for this one, this other one here, the 200 was remaining constant. The same applies here, 100. But because this is cash settled shares, you look at the market price in the year 2016, it is 60 shillings. Multiplied by 3 over 3, or just multiplied by 1, because we are in the third year. You get accrued expense of 960,000. Then expense for the year 960,000 minus 676,667. You get 283,333. That is it. Simple, not complicated, straightforward. So just prepare income statement extract. The income statement extract, you just take the expenses for the year. Those expenses for the year. For the year one, 348, 333. The second year, 328, 334. Then 2016, 283, 333. So those are the figures which will appear in the income statement extract. Then statement of financial position extract, these are the accrued figures which will appear there. 2024, 348, 333. 2015, 676, 667. And 2016, 960,000. That is how it will appear in this particular account. I don't know whether you saw that one well. Was that? I don't know whether what I explained there. The extracts. Let me try to show you what I'm trying to say. Are those ones legible? They should be. However, if you have understood the first one here, the second is simple. Income statement extract, we are saying, you just use these numbers there. The expenses for the year, 348, 333, 328, 334, 283, 333. So income statement extract will comprise of the numbers you have in this column. Expenses for the year. I've shown you how to calculate this. The current minus previous, the current minus previous to get these figures. For the first year, it is the same. When you go to the second one, this is accrued. This figure comprises of first year and second year. So to get for the second year, just minus the previous. You get this. When you go to the third year, this comprises of part of this and part of that. To get what is for this particular year, minus the previous year, you get that. So expenses for the year, there will be the figures to appear in the income statement extract. Statement of financial position extract is the accrued expenses as calculated in this particular column. For first year, 348, 333. Second year, 676, 667. And year 3, 960,000. So that is it about share-based payment or share-based payments. That is International Financial Reporting Standards number 2. And I've told you how it arises is where you supply goods or services to a business entity, and in that situation, you may not be paid in terms of cash. You may be paid in terms of equity, like share options. Instead of being paid cash, you may be issued with equity or shares. Other times, you may be paid cash, which is determined in terms of the prices of the equity of that particular business entity. That is what we are saying. So important thing to note here is the types of share-based payments, and I have told you, equity settled share-based, cash settled share-based, or equity settled or cash settled. Those are the types of share-based payments. Now, after knowing those 3 types of share-based payment, note the difference as far as the calculations are concerned. If you are using equity settled, the difference is only here, this number. It is you multiply this figure by the price, the fair value of shares at the grant date. Multiply this value by the price or the fair value of shares at the grant date. If you are using uh, cash settled, cash settled, then you use fair value of shares each particular year. So this will not be constant. As you can see here, you used 55, 58, and 60. So quite simple. So if you want to understand the difference between equity settled shares and cash settled, just look at this question which you have done. September 2021, question 3B, advanced financial reporting, and December 2017, question 2B. For September 2021, question 3B, this is equity settled shares, and you can see we are using the fair value of shares is at the grant date, which was 40. Then you look at December 2017, which is cash settled shares. You can see we are using fair value of shares each year. Each year, what is the price? For the first year, it was 55, second year, 58, third year, 60. And you'll be able to understand that. So you come to the end of that. Let's not spend too much time with the share-based payments because it's quite simple, it's quite straight. Once you read the theories relating to this, which we have discussed, you have discussed these theories, and I think you have that, YouTube. You can just get that class, YouTube. The theory, the discussions, we have them in the YouTube, and then you compare with our workings there. So if you have any challenge or any question, you can just contact us. The numbers are there. Plus 254 727 8710 93 0. Now this is a code for Kenya. This is a code for Kenya. A code for Kenya. Kenya is in Africa. It is not Africa which is in Kenya. It is the other way down. It is the other way around. Kenya is in Africa. It is not Africa which is in Kenya. So this is a code for Kenya, 254. If you are following from foreign countries, you start with plus 254. If you are within the Kenyan boundaries, just 0727 8710 93. So for any question, any inquiries, any clarifications, you can SMS, you can call, and you'll be able to assist you. So remember to subscribe so that you can continue receiving the updates concerning these discussions concerning advanced financial reporting. Now we are on which date? Date 7 October 2025. So the Kenya Accountants and Secretaries National Examination Board, the examination is the first week of December. So we have approximately 2 months remaining. So be part of us so that as we continue discussing advanced financial reporting, you'll be able also to take advantage of maybe some areas which you did not understand from wherever you are studying from. Then you'll be able to compare what you have from your side with what we are discussing on this side. So don't forget to subscribe for your own advantage and also for our advantage. Like the video, you make a comment, and in case you have a question, you just need to call this number. We are based in Thika. We are based in a town known as Thika. Thika is in Kenya, just around 40 kilometers from Nairobi, the capital of the country. So again, if you are within Thika, you can still just attend physical classes and you'll be assisted as much as we can. So we stop at that, and then the next discussion now will be about impairment. Impairment, we'll take impairment, and then uh, financial assets, and do we have anything known as financial liabilities? Is that what you study? Financial liabilities. Is that the correct name? Let me see what the correct term. Financial assets and financial liabilities. I believe that is what is in your syllabus. Now let me confirm that for you. What is remaining? Now what is remaining? What is remaining in chapter 1 before we go to chapter 2, which is about group accounts. Now, chapter 1, I told you, we have leases, which you have done, deferred tax, which you have done, employee benefits, which you have done, share-based payments, which you have done, you have concluded. So, we have the next thing is financial assets and financial liabilities, then impairment of assets. So, we have two things remaining in chapter 1. Therefore, 2 days or 2 lessons more, so that by next week we will start group accounts. So make sure you subscribe so that, especially the group accounts, which gives most of the students a lot of challenges, because this is an area which has a voluminous question. Therefore, interpreting the meaning of this question, trying to show the workings, preparing consolidated income statement and consolidated statement of financial position, it will take you a lot of time. If you don't understand these concepts, then you may end up getting the whole question wrong. So, as that is for your own advantage, you subscribe so that when we start group accounts and group cash flows next week, we may move together. But in any case, if you have not been a part of us up to this level, then you can still get chapter 1, most of these topics in our YouTube. You still get them from there. If you need any clarification, just SMS, the number is there, or you just call us. We will assist you as much as we can. So we stop at that. We meet again tomorrow. I think this is clear. I think it has helped you. If it has helped you, then you just need to make a comment there. You can maybe say thank you very much. It has helped you after subscribing. So I think that's enough for that. So we meet tomorrow. Again, now before I leave, I also remind you that it is not only advanced financial reporting that we are doing. We still have advanced financial management. We still have advanced taxation, advanced management accounting, and also other areas of accounts, including the lower levels, including ATD, Accounting Technician Diploma, CPA Foundation, CPA Intermediate, CIFA, that is Certified Investments and Financial Analysis, Foundation, Intermediate, and Advanced. We still have books for CIFA and ATD and CPA. So in case you need revision materials and study texts, you can still call the same number. You ask whether uh, we have the kind of book that you are looking for, and maybe what's the price and where can I get these books and such others. So it is not only advanced financial reporting that we analyze or we take together as a class, also other subjects, we also teach other subjects. So in case you need assistance, then you still call this number, you'll be directed on the way forward. So I wish you well as you continue waiting for the examination. Thank you.